Welcome to our comprehensive guide, Do-It-Yourself Investing, 11 Fatal Mistakes to Avoid. In today's fast-paced world, the appeal of DIY investing has skyrocketed. As the ease of access to online platforms increases, and unregulated influencers peddle their get-rich-quick strategies, many are drawn into the realm of managing their own investments. Tantalizing prospect, isn't it? The idea of achieving superior returns at minimal cost, all while maintaining control of your financial destiny. But here's the catch. The world of DIY investing is a relentless fight for profits. Nothing worthwhile comes easy or free. The journey of DIY investing, while empowering, is strewn with challenges. And the key to success? Continuous learning. Because the financial market, my friends, is a complex beast. Now let's delve into the 11 fatal mistakes that DIY investors often make and learn how to avoid them. Our first fatal mistake, relying on tips or cocktail party chatter for investment ideas. Yes, it's tempting to act on that hot tip from a friend or the latest buzz at the water cooler, but remember, investment is a serious business, not a gossip game. It demands diligent, independent research. Falling for the allure of hearsay can lead you down a dangerous path strewn with bad investments. Make decisions based on facts, not chatter. Remember, good investing is not a gossip game. Next, we have the oversight of research. In the world of DIY investing, it's tempting to dive in headfirst based on a hot tip or gut feeling. But remember, a lack of thorough research is like sailing a ship without a compass. The sea of investing is vast and unpredictable. Without solid research to guide your decisions, you risk losing your way amidst the waves of market volatility. The key to successful investing lies in understanding your investment. In the world of investing, knowledge truly is power. Scene script. Mistakes 3 and 4. Letting emotions drive decisions and trying to time the market. In the throes of market volatility, it's easy to let your emotions take the wheel. Fear and greed can lead to hasty decisions, like selling off investments during a downturn or piling into a hot stock. But emotional investing often results in buying high and selling low, the exact opposite of a successful strategy. As for market timing, it's a tantalizing game that even the savviest of investors struggle to win consistently. The financial markets are influenced by a multitude of factors, many of which are unpredictable. Trying to time your buys and sells perfectly can lead to missed opportunities and unnecessary stress. The antidote to these pitfalls? A disciplined, long-term strategy. Stay the course, stick to your plan, and resist the urge to react to every market swing. Remember, investing is not about perfect timing, but time in the market. Now we move on to understanding risk tolerance and managing portfolio risk. Picture this. You're on a roller coaster ride. The ups, the downs, the twists and turns. They're exhilarating for some, but terrifying for others. Investing can feel the same way. Your risk tolerance is essentially how much of this roller coaster ride you can handle without losing your nerve. It's crucial to comprehend this before you start investing. Misjudging your risk tolerance can lead to impulsive decisions like selling out during a market dip, which might hurt your long-term returns. Then there's portfolio management. Think of it as the safety harness on this roller coaster. It's about diversifying your investments, balancing risk and reward according to your risk tolerance. It involves regular portfolio review and rebalancing, ensuring you're not overly exposed to a particular sector or type of investment. Risk management, not return chasing, is the key to long-term investment success. Our final points? Underestimating fees and costs and failing to stay informed. Let's delve into these critical aspects of DIY investing. First, let's talk about fees and costs. Every investment carries with it certain costs. Brokerage fees, transaction costs, management fees, they all add up. And while these costs may seem insignificant on the surface, they can erode your returns over time. Imagine you're climbing a mountain. Each fee is like a pebble in your backpack. The more pebbles, the heavier your load, the slower your ascent. So it's essential to be aware of these costs and factor them into your investment decisions. But how do you keep these costs low? The key is to be strategic. Opt for low-cost index funds or ETFs when appropriate, negotiate lower fees with your broker and make fewer but more thoughtful trades. Remember, every dollar saved in costs is a dollar earned in returns. Now let's turn to the importance of staying informed. The markets are not static, they're dynamic and ever-changing. Think of them as a river, constantly flowing, never the same from one moment to the next. As an investor, you need to be like a skilled sailor, adjusting your sails to the changing winds, navigating the currents to reach your destination. This requires a commitment to continuous learning. You need to stay updated with market trends, economic indicators, and geopolitical events. You need to understand how these factors can impact your investments. Read financial news, subscribe to relevant newsletters, join investor forums, attend webinars and seminars, immerse yourself in the world of finance. But remember, information is only useful if you know how to interpret it. So, invest in your financial education. Learn to analyze financial statements, understand market indicators, and make sense of economic trends. In conclusion, successful DIY investing requires diligence, discipline, and a commitment to continuous learning. It's not just about picking the right stocks or timing the market. It's about understanding the costs, staying informed, and making thoughtful, informed decisions. Because at the end of the day, the most valuable investment you can make is in yourself. We've covered a lot of ground today, highlighting the common mistakes in DIY investing. It's easy to fall prey to cocktail party chatter or to let emotions drive your financial decisions. But remember, investing demands rigorous research. Trying to time the market or chasing performance can often lead to disappointment. Instead, understanding your own risk tolerance and implementing effective portfolio risk management strategies can pave the way for long-term success. Underestimating fees and costs can put a significant dent in your investment returns. Therefore, always be aware of the hidden costs in DIY investing. Lastly, staying informed about the ever-changing financial landscape is crucial to making wise investment decisions. Remember, the journey of DIY investing can be rewarding, but it requires dedication, discipline, and a commitment to continuous learning. Thank you for joining us, and we look forward to guiding you on your investment journey.